Hi everybody, this is Seth Martin. Welcome to the Middle Class Investor. Well, last week we had a pretty exciting week. Another week of volatility in the market. What you're seeing here is our rising wedge we've been talking about. We'll talk a little bit more about that in just a second, but I wanted to show you what the week looked like. Let's zoom in on this week and let's talk about this week because it was actually pretty significant. So what happened is the market opened right in this area. Okay, the market opened right here in this area. The bears pushed it all the way down to this point right here, so below 1825, and the bulls pushed it all the way back up to this area right here. So that's a pretty big range for the market, and it's one of the reasons you see the volatility so high right now. So the range on this day was almost 100. On this week was almost 100 points on the S&P 500, and that is not insignificant. And as a result, you can see the volatility was much higher last week. In fact, it opened right here, pretty close to where it is right now, ran all the way up here, and then ran all the way back down to this point. Still up above this second trend line that I have, and way up above this lower trend line I have. So I think it's safe to say that volatility is going to be with us for the short term. Now, volatility it works both ways, so it doesn't just mean down. It could also mean up volume as well. So don't take volatility to mean always bad, but it just means, really what it means is, it means that the probabilities of hitting kind of what the market makers and the people that are in the market hitting the numbers that they think they're going to hit, they become less probable and therefore more uncertain. And when it's more uncertain, there's a greater range of numbers that it could hit. So that's really all it means. It expands the range of possible price action. That's kind of what volatility does. So this is the Dow, and I think the Dow is really more. It's not more significant, but there's an interesting pattern here in the Dow, and I think it's somewhat in control, and so I'm pretty focused on it. Let's go to a daily chart here and let's look at this a little bit closer. You can see that the Dow broke through this kind of, it's kind of a rising wedge also, but this pattern has a name, and it's a terminal type pattern. So when this pattern happens late in a rally or late in a bull market, it tends to be terminal. So you can see it broke down hard through it. Actually went through our box of support, and is now bouncing. And I don't know if it's going to get all the way back up here to 16.8. I think it's going to fall a little bit short, and then I think we're going to see the market come back down here. So I don't think we're through going down, but we're probably not going to go much lower on this trip down to about maybe 15.5, somewhere between 15.8 and 15.4. Maybe slightly lower, maybe 15 even, but we'll just have to wait and see. But let's go back to the S&P 500. Let's see what the down target there looks like. The S&P 500 I look at more often, so I'm better at picking the targets. Although I was off. This low, I said that we would go down to about 1860. So I was looking for a low just above this area, and you can see that we went significantly lower than that, down below 1825. So it was a little bit off on that targeting. But I think what will happen, what I'm seeing here is we'll probably move a little higher here, just slightly, not much, maybe this 1910 area at the most, and then probably roll down in here to either 1800, somewhere between the 1775 or so, 1760 to 1800. And then we're going to have a really strong pop after that. But it's going to be what's called a sucker's rally, I think. That's what it looks like to me at this point. So let's just draw this out real quick. I think you could see the market go a little higher and then come down pretty hard into this area like so. And then maybe something like that. So, you know, it could be another 100 points down after it stops going up. And that's, you know, that's pretty scary, and obviously volatility will go higher. I'm going to erase it real quick because I'm going to condense the move a little bit to show you how where we might go to on the way back up. Now this rally is going to be pretty significant. We're gonna whoops. That's interesting. It it popped over on me. Probably because it was too vertical. So let's try this again. So we're going to come down, find a low. Let's say it actually goes through the box a little bit. And then we're going to have a really strong rally back up. It'll look like, that's not going to work out. And then, you know, I think we're going to get pretty close to the bottom, to the underneath side of this this lower line. So we're gonna be, maybe we might make it all the way back to 2000, but certainly we're going to be close to this 2000 area. And then I think the next move down, this is just going to be a sucker rally. It's going to suck in a lot of bulls. Yep, that was the dip, blah, blah, blah. It's going to sucker a lot of people in, and then it's going to fall pretty hard. So, you know, there's always a possibility that that doesn't happen, that it actually goes to a higher high. The problem with this, you know, this going and making a higher high at this point is it's broken decisively through this bear wedge. And like I said, this, and if you've been watching these YouTube videos for any length of time, I said that once you break below this, once you get a close below this, let's go to the weekly chart, because I think it's important to look at the weekly chart when you're talking about this pattern. But we've decisively now closed below this. In fact, a great entry on the short side, you know, we came below here, retested it, and then went down. So I think you could, I mean, obviously you could get a retest all the way maybe to the midline up here, even above 2000, maybe 2010 or so. But there's two things I need to say about this, because I've already had people ask me about it, so I want to go ahead and comment on it now. One, this is going to be a sucker's rally, and two, it's going to happen very, very fast. So if you're in your 401k or something like so, let's say that the new low comes down into this area. Let's just measure that amount of time. Let's say it takes until here, okay? That's roughly 40 days, so maybe even less, maybe 38 days down to the low. A lot of times these sucker rallies can take half that amount of time. So you're really talking about maybe 2 weeks to go back up into this area. And 2 weeks is usually not enough time to get in and back out of your 401k. So now there's going to be times when we could go back in, but I've had people say something to me about it, so I wanted to comment on it here. But closing below this wedge, as I said before, that increases the probability of this pattern happening to about 93%. So what does that mean? Let's go to a 10-year chart, and let's talk about what the pattern means. So basically, if this rising wedge happened over this entire time frame, which is what it looks like to me, it's done. But let's say that really only to here. Let's say the pattern started here and not back here, but I think it started back here. But let's just assume it started here. Well, if you take the high to low from here to here, let's do that real quick. That is 290 points. So now, So now let's come from the bottom of the wedge where it broke out, which is right here, and go down 290 points. Got a little something in my throat. Sorry about that, everybody. That brings us to about 1650. And I'd say probably a better target would be even around here to 1550. So that's what tells me personally. Now, predicting the market is a very tricky business. In fact, predicting, it's really not what we're doing here. What we're doing here is we're saying, look, the market has a certain pattern right now, and I don't know, some of you might not have been around when we talked about technical analysis, what is technical analysis and things like that, but there are certain tenets to technical analysis, and that's what talks about that. There's where the rules are derived to give us what happens when a rising wedge fails. So maybe I need to go back into that at some point, but right now I don't want to get into that because I want to leave you with a fairly short video at this point. So just suffice to say that when a rising wedge breaks out, and this has to do with the technical analysis phenomenon, you get a drop of whatever the width of the wedge is at the starting point of the wedge. So we did 290 points, which brought us to the 1550 area or 1600 area. But you could go back to the start of the pattern, and it's somewhat subjective. But you could say that the pattern started in 2009, in which case the width of the wedge was some 400 points, which takes you even lower. So that's what has me saying at this point that this is probably going to be a sucker rally. It's going to draw a lot of people in. It's going to be very fast. It's going to be very hard. You're going to have people saying that was the dip. If you didn't get in, you should have gotten in, blah, blah, blah. So that's what I say is going to happen. Let's look at the 10-year interest rate. Let me go to a weekly. Now this was a crazy, crazy move. I mean, I've just never seen anything like this. And we'll zoom in here in a minute, but I want to show you this move right here. This was in the yields. Well, over the week, the yields moved. The range was 4.18. And in percentage terms, just to talk about how significant that was, from high to low here in the week was almost a 20-point move, 20 percentage points. That is extraordinary. So what it's almost looking like at this point is so the bond market moves in the opposite direction. So this sometimes is referred to as a blow-off top. So if you envision this being up, where the bears came in right here, they ran it up a little bit, or excuse me, they ran it all the way down to this area. So briefly, yields were below 2%, and then ran it all the way back up to here. So on the bond market, just the opposite happened, right? You had the bulls run the market up. In fact, let's just look at let me do that real quick. I got the gold chart up here, but I think it's important to understand what's going on in the bond market because it is not insignificant. So you can see here, the bulls, the market opened here, okay, right down this area here. The bulls ran it all the way up here, okay? This is the 10-year treasury, and the bears pushed it all the way back down here. So anytime you get a long tail like this, this is a lot of bullish people getting caught short, and the market reversed on them. If you get if this week closes below here, then the bonds are going lower. Okay, that's likely to happen. If this candle closes down somewhere down here this week, then bonds are going lower. So said another way, if the yields close up above 2.29 this coming week, then that's it for the yields. The yields are going higher. It doesn't matter what the Fed does. The bond market is going to take the yields higher. So we'll look for that to happen. I would say this looks like a pretty strong support. Anytime you see something like this in reverse, this is likely to be the bottom. These are bottom marking type candle situations. Now let me just for grins, let me put it on a 60-minute. This is, in other words, each one of these bars is 1 hour. And I just want to show you that in a matter of a couple of hours, the yields were, just the bond market was doing some crazy stuff. So on this day right here, the 15th, or let's talk about the 14th, the bonds closed, or the yields closed right here at 2.2059. Okay? They gapped down to here and then ran down hard all the way to here. So in a matter of just about 3 hours, the yields dropped 15%. That is one heck of a move. And then the bulls came in, or the bears really in the bond market came in and pushed the bonds back down and kind of took over the market. So if we get a close up in this area this week, then I think you're not going to see yields come back to this level for a very, 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 very long time. This is why I've been saying if you've got suckered into this high yield talk, or if you're in bond funds, you're really going to be hurting in a bad way, and you need to be thinking about exiting those positions, in my opinion. Now, look, it's your money. You get to decide what you're going to do with it. But if this is the first move, and we've talked about this before, if this is the first move off the bottom, this has already been identified as a bottom. If you go back and look at a big chart, this is a low. This is an important low, okay? And this is the first correction. Let's call that the correction into the first low. Then this move right here is going to be big. Okay, so I think a good safe bet is if at the end of this week we're above that level right there, you can exit the bond market and feel pretty good about that trade, getting out of that. All right, enough of that. Let's go to the euro, another very significant market right now. And you can see that the euro sold off pretty hard for several weeks, several months here, and finally found support here. In fact, we were talking about, well, initially we were talking about support here, that broke. Then we talked about support here, that broke. It looks like this support here is going to hold, at least for the time being. So you'll see the euro, maybe it's already bounced. Maybe it can bounce back up. And I don't know if you can see this, but there's a slight little V, like a little V, and then up here, and then it resumed. These tend to be places where the market could retrace to and then resume the down. So it could go to here and then resume down, or it could meander its way back up and have a big bounce here. So we'll just have to see what happens, but it looks like for the time being this is going to hold. Let's look at the volatility index. Again, I think we've already looked at this, but let's look at it again real quick. You can see that our slow trend line is intact here, as well as our fast trend line. So I think you'll see volatility spike even higher sometime during the week, but then it'll correct back, and this trend line should hold. So we could get a substantial correction in volatility, which means the market's going to rally pretty hard. And that's just very normal. The market rallies really hard and then it falls, and then it rallies really hard and falls. And so the difference is, what you got to look for is the difference between bear markets and bull markets is obviously the falls in a bull market are much, much harder than the rally. So if we start to see these directions looking much more hard and these directions failing to make new highs and then lower lows, then that's a bear market. That's a turn. All right, let's look at gold real quick. Yep, we got to get off the bonds. I switched to bonds earlier. Show you guys something there. Okay, here's gold, and you can see here the 2011 high came down, kind of chopped, and then came down really hard. And I think I mentioned at the time that, a hard move like this, where you get a low and then a lower high and then a real hard sell-off, that this would tend to be a consolidation and a continuing downtrend. And then I had this line here, this 1238.50 line marked, and we went through it, which portends to me that we're going to make a lower low, lower than this low right here. So right now we're correcting some of this. You can see that gold get up into this 1270, 1275 area before we make a low, another low. So look for that to happen. I mean, if you're short gold, you want to stay short gold. I mean, you're gonna feel some pain as this retraces back into this area, but you'll soon be rewarded as gold rolls over again and comes back down. So that's what gold looks like to me at this point. The dollar's another significant market right now. The dollar looks like it's correcting, and I think I said last week that you could see the dollar. Let's look at the UUP, since that's what we were looking at last week. So I think I was saying that look for the dollar to correct back into this 22 area, the low 22s, before it resumes higher. And I think that's it may be done actually here. It's hard to say, but it may be done at this point. It may make a new high and then come back into the 22 area. So I still think whether it goes higher from here and then down, I think a good place to enter in the dollar is going to be around this 22 area. So and possibly even a little lower, maybe even this 2170 area. So don't. I mean, you can get into the dollar anytime, but just understand that if you get in right here, you're gonna likely experience a pullback into this area. So really, roughly a dollar pullback from here. So I guess that's about it this week, everybody. I just wanted to make it clear at this point that you're going to see some lower prices from here, probably into that between 1750 to 1800. If you're still in the market, if you're still long the market, try to have a little. It's hard, okay. Once you're kind of thinking bear market, it's hard to sit through, a sell-off and wait for a bounce. But if you can wait for this bounce into this area before you exit either some or all of your 401k, you'll be glad you did, because you'll make back this money that you've lost in this downtrend, which is not over. So again, we're going to probably come down into this area, retest back up here around 2000, and then sell off hard. So if you can wait for that retrace into this area, you'll make some of your money back that you lost, and B, it'll be like it'll be almost like you got out at the top. So it's once you kind of get used to, okay, this is the first move down and this is going to be the first correction, you can really, it's not timing it, because timing it would have been, say, picking one of these right here as the top and saying, okay, that's it, I'm out, which is fine too, but that's very difficult to do. I mean, how do you, if you're looking at, let's say you're right here. Let's zoom in right here. How do you know if this is the top, or or if that's the top, 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 or if that's the top? You see what I'm saying? It just becomes, you're just really guessing. So a good disciplined way to do it is to wait for the first move down. You're gonna lose some money in your account. It's gonna draw down, and then look for a significant break of support, which is right here, and then a retest back up to a higher low. It starts to roll over, and boom, you get out. Okay, or you take a bunch of money off the table. It's kind of like playing craps. You got a bunch of money out there. It's been out there for a while. You start taking some of the money off, and then within a few rolls, 7, you're out. So kind of like that. Again, watch the interest rate market. If you're watching TV, they usually show the 10-year Treasury yield. If you see that above 2.2 or 2.3, 2.3, let's call it 2.3. If you see that above 2.3, you've probably seen the low in yield. So if you're thinking about refinancing, you maybe should have already done it, or you should be doing it right now. And then you should be looking to exit those bond fund positions. Okay? All right, everybody. Thanks for coming into the Middle Class Investor. Really appreciate it. Send the links to your friends and family. Help them not to lose money. And let's sleep good at night. Everybody can sleep good at night, and preserve your capital. And let's wait for a great opportunity to enter long and make some money on the long side. Okay? Take care, everybody. See you later. Bye-bye.